Welcome back to The Explainer. So, I am beyond excited to dive into today's topic with you because we're going to do something actually incredibly powerful. We are going to completely dismantle some of the absolute biggest financial illusions out there, and we're doing it using hard, undeniable math. Too often in finance, we all get swept up in the story, right? The hype, or just those default options that literally everyone else uses. But today, we're pulling back the curtain. We're going to look at the actual realities that dictate your wealth. So let me ask you this. What do the SpaceX IPO and your 401k actually have in common? I know it sounds like a bizarre setup to a joke, right? Like, what could one of the most highly anticipated, out-of-this-world space exploration companies possibly have in common with that boring retirement paperwork you filled out on your first day of work? Well, the answer sets the entire premise for what we're looking at today, and it's this. In finance, what you see is rarely what you actually get. All right, so here's our roadmap for this explainer. 1. The SpaceX hype illusion. 2. Pricing a perfect future. 3. The 401k statement mirage. 4. The invisible tax bill. And finally, 5. Building your winning strategy. Let's jump in. Okay, Section 1. The SpaceX hype illusion. Separating the rocket from the return. Now, if and when SpaceX actually goes public, it could easily be the most anticipated initial public offering, or IPO, in modern financial history. I mean, the name SpaceX alone just kind of does something to people. It completely short-circuits our normal, rational investing logic. It totally bypasses the part of your brain that asks boring but absolutely critical questions like, hey, what does this company actually earn? And replaces it with the sheer awe of literally putting humanity on Mars. And that awe? Well, it's translated into an absolutely astronomical number, a $350 billion private valuation. $350 billion. To put that massive figure into perspective, that makes SpaceX larger than established giants like Boeing and Goldman Sachs combined. And get this, it's not just retail investors getting hyped. Sophisticated institutional players are buying in at these crazy levels in private secondary markets. And to be fair, looking at their history brilliantly illustrates exactly why people are so incredibly confident. Look, SpaceX is undeniably an impressive business. It was founded back in 2002 with what, at the time, seemed like a totally suicidal mission. And by 2018, the company was quite literally days from collapse. I mean, days, until their fourth Falcon 1 rocket launch finally succeeded. Fast forward to 2024, and they've got over 6,000 Starlink satellites in orbit, generating literal billions in recurring revenue. They have built genuine, undeniable competitive moats through basically immense near-death survival. Which brings us to Section 2, pricing a perfect future, the danger of IPO excitement. Here's the thing you absolutely have to remember. An impressive company and a good investment are completely different things. Private market valuations are essentially negotiated fictions. But when a company goes public, that fiction slams headfirst into the relentless reality of the stock market. Just look at recent history. We see this undeniable, frankly painful pattern where highly valued private darlings consistently humble retail investors once they face public reality. Uber dropped over 7% on its very first day. Lyft lost over 70% of its value in a single year. WeWork literally went bankrupt. And Rivian, which was at one point valued bigger than Ford and GM, lost nearly 80% in a year. They were all priced for a perfect future, and the present just kept showing up to ruin the party. I love this quote because it summarizes the brutal valuation math perfectly. The distance between a great company and a great investment is measured in price, period. When you buy a stock, you are buying a claim on future profits. That is it. So at a $350 billion valuation, standard financial models suggest SpaceX would need to generate between $20 and $30 billion in annual profit within the next decade just to justify its price. Think about that for a second. That means SpaceX would literally need to out-earn virtually every aerospace company on planet Earth, combined, within 10 years, just for you to break even on that valuation. You are paying full price for a dream where absolutely everything has to go flawlessly right. All right, let's pivot to Section 3. The 401k statement mirage, 2 traps, 1 office. See, you don't actually have to wait for a massive tech IPO to fall for a financial illusion. Millions of us fall for one every 2 weeks when we get our paychecks. So we're moving from the rocket ships of Wall Street to the spreadsheets of your own retirement. Meet Jake and Marcus. These guys are 2 coworkers sitting maybe 10 feet apart in the exact same office. They have identical starting parameters, both are 30 years old, both make a $75,000 salary, and both invest $10,500 annually. That's $7,500 of their own money, plus a $3,000 employer match. But they have completely different tax philosophies. Jake checked the box for a traditional 401k, meaning his money goes in pre-tax. Marcus, on the other hand, checked the box for a Roth 401k, meaning he pays his taxes up front. So they log into their accounts over the decades, right? Year 1, they both have $11,200. Year 10, they both sit at $155,000. Year 20, they both hit $461,000. It's the same contribution, the exact same match, the same growth. Honestly, if they printed their statements out and laid them side by side on the desk, they literally couldn't tell whose was whose. For 20 straight years, their quarterly statements create this incredibly powerful mirage of equal wealth that is actually hiding a massive underlying difference. Let's uncover that difference in Section 4, the invisible tax bill, who actually owns your money. It is time to absolutely shatter that mirage and reveal the hidden liabilities lurking beneath the surface, because those identical numbers, they are lying to them. You see, Marcus thinks his entire account is Roth, but it isn't. At most companies, the employer match goes into a traditional pre-tax bucket by default, even if you are contributing your own money to a Roth. So Marcus's account is actually a hybrid. Only 72% of it is his Roth money, while 28% of it is secretly sitting there in a taxable traditional bucket. And honestly, almost no one knows this when they're setting up their accounts. So let's look at what actually happens to that $461,000 balance at year 20 when we finally factor the IRS back into the equation. Assuming a 22% tax rate in retirement, Jake owes the IRS roughly $101,000 because his entire account is pre-tax. So his real wealth, it's $360,000. Now, Marcus only owes taxes on that 28% match portion, meaning he owes about $28,000 to the IRS. His real wealth is $433,000. Despite staring at absolutely identical statements for 2 decades, we can see a massive $73,000 after-tax gap in Marcus's favor, and it was completely invisible on paper the whole time. And for poor Jake, it actually gets so much worse over a full 25-year retirement, because every single dollar he pulls out is taxed as ordinary income. And because those withdrawals can trigger taxes on up to 85% of his Social Security benefits, his traditional 401k could trigger a brutal $188,000 tax bomb over the course of his retirement. I mean, wow, he pays a massive penalty simply because he chose the wrong bucket to pull his money from. Meanwhile, Marcus is paying a fraction of that. Which brings us to our final part, Section 5, Building Your Winning Strategy, the Arithmetic over the Dream. To avoid these traps, we really have to build an actionable math-first strategy. We need to shift away from the hype of Wall Street IPOs and the default traps of corporate onboarding. Now, the whole traditional versus Roth equation basically flips based on a single, absolutely vital assumption: whether your tax rate in retirement will be higher or lower than it is today. So if you are young or in a low 10 to 12% bracket, go heavy Roth. Paying those low taxes now to avoid taxes on decades of compounding growth is just an amazing trade. If you're in your peak earning years at a 32% or higher bracket, go heavy traditional. Take that massive tax break today. And if you're hanging out in the middle at 22 or 24%, split it half and half to give yourself some serious tax flexibility in retirement. Look, most people set their 401k once and literally never look at it again. That is a 6-figure mistake. You absolutely must avoid the set it and forget it trap by actively managing these 3 simple steps. First, always get the full employer match. I mean, that is literally free money. Second, constantly check your current tax bracket against what you actually expect in retirement. And third, rebalance your contributions as your career evolves and your income grows. You have to protect your compounding wealth by adjusting your strategy along the way. So I want to leave you with this final, really powerful thought. Whether you are caught up in the incredible dream of making humanity multiplanetary through a SpaceX IPO, or you are just staring blankly at a default enrollment screen at your new job, you have to ask yourself this one critical question. At this price, what has to be true for me to make money? Seriously, don't ask what could be true, ask what has to be true. Look past the illusions, look past the mirage on the statement, and always do the arithmetic. Thank you so much for joining me on this explainer, and I really hope this helps you build a smarter, much clearer financial reality. Catch you next time.